Been a tough year being a property investor? Rising interest rates got you second guessing? Not sure who to turn to for help? You need to reach out to Australian Property Scout, one of Smart Property Investment's most trusted buyers agency. Director Sam Gordon has personally helped many SPI show listeners invest to reach their financial goals using his purpose-built strategies. So what are you waiting for? Head to www.australianpropertyscout.com.au and book in a call with us today.
This is a Momentum Media production.
Welcome to the Smart Property Investment Show, the podcast by investors for investors.
Oh, g'day, how you going? It's Phil Tarrant here. Hope you're well. Welcome to another episode of Smart Property Investment. Been at it last couple of months, getting stuck in, chatting to a whole bunch of investors, which I do enjoy. And it's just a sage reminder that no two investors are the same. It's people buying at different asset classes for different reasons, at different parts of their journey, life stage. Some are young, some are older, some are nearing retirement, some are decades away from it. And it just always gets me thinking and reflecting that, geez, I wish I started a little bit earlier than what I did. I didn't start too late, to be fair, but probably could have started investing in property 5 years sooner. But anyway, we'll leave that for another podcast. But welcome. Have you been tuning in, dialed into what's being going on in the world? Lots of numbers coming out of the sort of economic bureaucracy at the moment. I spent some time down in Canberra recently for the budget. Not a lot of big headlines there in relation to property other than money getting thrown at trying to sort of create more investment properties really, and some affordable housing as well. So we reported on that. We covered it at length in smartpropertyinvestment.com. You go and check it out if you want more details about it and what it all means for property investors. But two sides of this coin, really. We chat with property investors, then we also chat with people who help property investors. And today's going to be very much the latter rather than the former. But if you are keen on come and have a yarn with us on the Smart Property Investor Show, if you are a property investor, irrespective of whether you own a property yet, whether you're on that journey or just started, or whether you own many properties, as I mentioned beforehand, investors come in all shapes and sizes. So we'd like to have a chat with you. You can email the team. We'll get it all teed up, and it's pretty straightforward. You can do it via Zoom if that's what you'd like to do. Today I'm in the studio, but editor at smartpropertyinvestment.com.au is where you need to go. Now, some of the numbers coming out of, you read them any day in the newspapers around spiking inflation, fuel prices about to surge again, supply chain constraints. A lot of those issues running off the back of COVID still exist globally, and obviously challenges, the war in Europe. All these things are compounding to create an economic environment with a lot of people are unsure of and uncertain about. My read of it is that we are in a market, I've been sort of quite vocal in this, a very sort of stable property market. No one's market really. There's not a buyer's market. It's not a seller's market. There's no one's market at the moment. You're not seeing distressed assets coming onto the market. I think most Aussies can hold on to their property. That may change. Recent rate announcement and sentiments that it will continue over time. So there's a lot of people questioning what are they going to do. I want to chat about that today. But importantly, what I want to chat about is the long game, the compounding effect and impact of property for property investors, and that's what we all subscribe into. Some say it's the eighth wonder of the modern world is compounding interest, compounding property values. Chat through this. Paul Glossop, he's the director, or managing director. I think he's that. A Pure Property Investment. He's also the, he was going to tell us about it, so I may as well get on the front foot. The author of the Surfer's Guide to Property Investment. We're all waiting for a second installment of what about the Skier's Guide or the Snowboarder's Guide to Property Invested out of the Seiko? You can take me there on a tour.
Unbelievable.
Yeah,
straight away, hand in
go to the Seiko.
Hand in my pocket.
Go to the Seiko. Deep powder.
Deep pow.
The property market is just like the Seiko deep powder.
I actually just saw some specials for Ski Japan only very recently. I was actually considering it.
Mate, get some. I'll go.
Yeah. No, I'm sure you will.
There's actually
if I'm paying is probably the next line. Yeah.
Maybe if you're interested, we can do a property tour to Naseko. There's actually a couple of Aussie, real estate brands in Naseko. I think LJ Hooker could be there. I think it's some Aussie guy runs it.
Yeah, there is. Yeah. I think they tried at some stage. I don't know how flourishing it is because the Japanese property market hasn't been that stellar over the last couple of decades.
No, but their interest rates are stable.
Yeah, absolutely. The economy's been stable. No, they don't move too much. Stable.
It's stable. Heavy on the stable table. But we'll have a chat about this sort of compounding nature. And I think a lot of people get it, but they probably don't understand the science of it. But what's your take on where we are economic-wise and mindsets towards it as property investors? Is now the time to, you'll probably read it in the papers, inverted commas, snap up an investment bargain? That's what the mainstream papers will tell you.
Mate, it gets a bit boring, that kind of conversation. You've had it more times than I have, mate. But when you get into this type of, I guess, theme of a cycle, a lot of the time is, where should we be buying? Is it time to snap up a bargain? Well, what you've just, I guess, had your lead in time too is that the compounding effect of property is the exciting part, and it's very, very complicated. Or I wouldn't say complicated, it's actually very simple, but probably what's harder is for would-be first-time investors. And you mentioned earlier in the piece when you were doing your intro, mate, is that, you started relatively young, but you could have started younger. And if you did, it probably would have been a little bit early. You would have been over in Japan probably a couple of extra times a year, a little bit early, when your back probably bent over a little bit further, and you could do up your boots a bit easier, etc. But I think that's the part which, for me, that's what needs to be reminded in these cycles, is that this is the time for people to realise that the markets aren't moving at the heady heights of what they were over the previous 2 years. And to be fair, that only happens every other probably couple of decades. So don't expect that to happen anytime soon again. But this is the time where you can actually take stock. You can be very well prepared. You can have your money in order, and you can actually go buy property with some really good strategy in place to not only support the longer term growth, but longer term cash flow, and get what is that eighth wonder of the world, which is that compounding interest.
Do they call it eighth wonder of the world, compounding interest?
I'm pretty sure. Well, it's touted as it, but when you go through the numbers, you realise why it's so powerful. And I think that's what I'd love to unpack today. Is essentially saying, look, you can make very, very meaningful money over a longer period of time if you have two things on your side. One of which is time. The other one is patience. Because one doesn't work if the other one isn't available in property investment.
Both. I remember doing as a kid, sort of the compounding nature of just stuff and doubling. If you start with a cent and double it for a month, I think you end up with $1 million and something.
It's well over $1 million, but it's not until the 27th or 28th
really
day where you actually tick the boxes, and it starts to actually, wow, that's an enormous number.
That's an enormous number. Yeah. You just double it every day.
Yeah.
Bam, 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 bam.
And look, I've got an example, Phil, so I'm happy to go through this for the listeners, because I think this is the key part, because whether you're 20, 25, 30, 35, 40, or even 45, what you're really in the ability to do right now is actually, when I say 45, that's not the cutoff, but I just like to go through the fact.
Are we talking about starting
age?
Well, I want to go through this example because it much better on paper, so it's going to be hard to do verbally, but we'll do our best around and give us some sort of colour. What's the sort of average age for your client base for when they start in property?
It's typically around the mid-30s.
Okay.
Yeah, mid-30s. I mean, I'd love it to be earlier. But if I'm to be honest, it's around about mid-30s. So shout out to any of my pure property clients who are younger than that, then good on them, because they've typically done something a little bit more aggressive in an earlier stage. Now, that might be that they saved harder, they've got a bigger income, they might have been able to leverage off bank and mum and dad at some stage. There might be, there's a variety of reasons, but about that mid-30s is when it can happen. But if you started that in the mid-20s, I get it. It's a sacrifice, because you do, and we're really similar ilks in the sense that the 20s are spent doing other things, and you go back, you're saying, would I have foregone, financial freedom in my 50s and 60s to give away my 20s? Well, the answer is probably no, I wouldn't have. But it doesn't mean that you be frivolous and put yourself in a crazy debt that you can't dig yourself out of as well. So there's, there's
and I reckon there's a way to do both now. I wish I'd frivoled away my 20s, having sort of maybe worked for a couple of years prior and getting an investment. Like you can be a backpacker now with an investment property.
Yeah, absolutely.
Right? Which probably wasn't really the thing to do when we were younger.
No, not at all. Not at all. And I think that's an interesting part, is that I know I do actually have a lot of clients who I know who are really early in the piece trying to set themselves up because they want to essentially say, hey, look, I might want to start a business, or I want to take a few years off. But I know if I do that, then essentially it's going to reset the time for me to start another 5 years. And because they know those compounding numbers, they realize it's saying, well, I actually have the ability to support a mortgage and also have the deposit. So if I can put the minimum amount of deposit, the property can be self-sufficient, and potentially I can recycle that into property number 2.
So that's the goal. If you can have an investment working for you, which is cash neutral, but it means that you need a big deposit, right? How do you get a big deposit when you're 23
decent
years
asset
old, right?
selection, yeah.
Did you find people that start early, and it's important because, we're going to talk about when you start and the impact of that, right? For people that start early, do they normally come from a background of sort of comfortable sort of financial positioning or comfort talking around finance? Like they must, a grounding in like good mentorship from friends or family? Is there any?
You know what, Phil? The reality is actually it's probably further to the opposite of that than it is to that alignment. And I think the more people get comfortable with the fact that they know that there's money that's available to them throughout their life, whether it comes earlier or later, their relationship with money is a little bit different. And their need to say, I need to anchor this, I need to start this investment journey sooner because I don't want to be risking it that I've got nothing available to me in retirement. I find that there's actually far more people who potentially haven't had any handouts and they worked for everything they got. And that still doesn't mean they have to start later because they had to work harder and save for longer. But the people who are actually in a position to do it more often than not, and I'm not saying that there's not people who are financially, come from a relatively wealthy family, aren't still ambitious and do it. We've got plenty of clients who are down that pathway. But those ones who really want to get going are typically the ones who are saying, look, the writing's on the wall, I've seen it. And not to say that my parents didn't go the way I wanted it, but they've seen that, look, if you don't do it now, you unfortunately just don't have the time. So time is your ally. It's everyone's ally, and it can be your enemy very quickly as well.
And one of the issues with timing about starting, start as early as you can, right? And you probably only really work out in hindsight once you've been at it well, whether or not you start at the right time and the right thing to do. But one of the structural things that's probably against you a little bit as a property investor is that at a point in time, the banks want to stop lending you money. So there's an egg timer there, which means that you've got a certain amount of time to play, i.e. take on debt in order to start a property to get to a point where you start paying your properties down. And once you hit 55 is when the banks typically stop issuing 30-year mortgages, right?
Yeah, and I think, look, that'll also change over time. I mean, you rewind the clock 30 years, and that wasn't the case then either. I mean, it was earlier then too, but now we've got longer mortgages, we've got people who are living longer, we've got people working longer, we've got incomes that draw out further. But you're absolutely right, is that you really need to understand that you need to get busy, but also when you get busy, that's when the other part comes into the fold, is that you can't just think, okay, well, I'm going to go and buy 10 properties over the next 20 years and all of a sudden everything's going to be honky-dory, because the reality of most people to be able to get to a 10-asset portfolio, it's pretty slim these days. So you need to be – I'm not saying that you need to find unicorns or gems, et cetera, because I think it's a bit of a misconception in the property market. You need to buy a decent asset in a decent market at the right time with the correct cash flow to support your portfolio. Time will support the rest of it, as well as ensuring that you tinker with the edges for the entire time. And that's adjusting your rates and making sure your rents go up when they should, making sure your property is updated when it needs to and how it needs to, and that your broker's been on your side the whole time. Because there's a few key parts there, your accountant as well. They're the things which you should always be in touch with. They don't really usually be monumental shifts or changes, but buying 1, 2, 3 assets within a 5-10 year period of time, basically what most people need to do. If you can hold for 30 years after that, the numbers will speak for themselves.
Yeah. So I think the key thing there is property is not a passive asset. So many moving bits to it. So if you want to be a property investor, you got to get your hands dirty. Yeah,
you do. But don't get overwhelmed with the fact that this isn't learning how to become a mechanic and someone unpacking a straight six and saying, put this back together and go and figure out how to drive the car. Not at all.
You're having a straight six.
I'm an EV vehicle man these days. Right? No servicing. Yeah. No servicing.
V8 all the way.
Of course you are.
But it goes to the point around numbers at the moment. It's certainly a lot of pressure on the household budgets for property investors, right? Yeah. You need to keep your numbers front in mind.
Yep. Yeah, absolutely.
Yeah, it's good. All right. Well, let's sort of run through a bit of a scenario then of, we're talking about the beauty of compounding interest, the eighth wonder of the world, whatever you want to call it, and and how it works. We'll get stuck in it. We'll just go to a quick break. Stay with us, everyone. Back in a moment.
Whether you're a first-time investor or already have a healthy portfolio, we all know there's a lot of stress that comes with property buying. That's why best-selling author and regular guest on the Smart Property Investment podcast, Paul Glossop, has outlined all his battle-tested investment strategies that have helped him and others upsize their portfolios, avoid money-draining pitfalls, and build wealth through property investing. Get your free copy of the best-selling book, A Surfer's Guide to Property Investing. Head to purepropertyinvestments.com now.
Welcome back, everyone. Phil Tarrant, host of the Smart Property Investment Show. I'm with Paul Glossop from Pure Property Investment. I'm just going to unpack compounding interest, or the positive effects of compunction.
I thought you were about to say kombucha.
I nearly said kung pao. That's what. How the compounding effect of price growth on your property. But before we get there, people will be going, Okay, I know what it is, right? But there's probably people that don't know what it is. If you knew this podcast, what does compounding mean?
So
compounding growth.
The simple way is that you could look at it two ways. You could start with $100,000, or to your point, that 1 cent doubled every day for 30 days. Works out to be, I can't tell you the numbers, I know it's in the millions, but it's not until you day 26, 27, etc.
It really hits it.
Yeah, you'll be able to Google it as we're going, no doubt. But I think the reality is that as opposed to 1 cent plus 1 cent plus 1 cent plus 1 cent for 30 days, it's not essentially that. Where the compounding effect comes in to really dull it down is to say it's 1 cent plus 1 cent equals 2 cents, plus 2 cents equals 4 cents, plus 4 cents equals 8 cents, plus 8 cents equals 16 cents. And as I'm going, Phil, you're going to give me what the magic number after I double that every day for 30 odd days equals out. And we're going to have a bit of dead air here, so a little bit of elevator music while we're waiting for it. Dun, 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 dun.
So $1 times 2, and then compounding from that is, I got 536 million. That can't be right.
1 cent.
No, it's $1.
No, it's 1 cent.
1 cent.
Doubled for 30 days equals $5,368,000. That's the number.
Have you got a fancy compounding machine?
It's called Google.
Oh, okay.
I do have a compounding calculator separate to that as well, though.
There you go.
But that's where it comes down to. So, and I guess the US call it a penny doubled a day for 30 days. So for me, that's the key, is that when we explain it really simply, you break that down and ultimately it comes down to it's over $5 million. And it's not until it's like day 27, 28 where it works out to be in that close to $1 million range. And then it's not until literally, so here's the table here. So by day 28, it's 1.3 million. Day 29, 2.6 million. Day 30, 5.3 million. And essentially you look at that at day 15, the actual doubling or the compounding effect is $163. So you realize that time.
Are you on TraderLine?
No, I'm not. I'm on Key Takeaways from, it's got a sponsorship for KFC on it.
You know they serve adverts in based on what you like.
I'm pretty sure you were holding my phone prior to me, so you probably punched something in there.
I got a free TraderLine model book. I got it here. Here we go. Yeah, that's funny. So day 15, it's $163.
And then you fast forward, mate, and this is it. And
so day 22 is 20 grand. Day 23 is 41 grand. Day 24, 83 grand. Day 25, 167 grand. Day 26, 355. So you go from day 26 to day 27 becomes $671,000. Day 28, 1.3 million. Day 29, 2.6 million. 30 days, yeah. That's compounding.
It's really, really quite simple that you realise that's the power of it, because people...
That's compounding at 100%.
That's compounding 100%. Now, obviously, we talk about the vernacular of property doubles. I don't like to hear people say it's every 7 years or even every 10 years. Typically, on average, 6.3% average annual growth over the last 30 years is what the average freestanding established home in Australia has achieved in a major city metropolitan area. So that's your number, 6.3% annually, which works out to be, call it 12 to 14 years, you double.
Okay.
So you go back to your little doubling there, though. So you go from, if you're holding for, let's call it 3 cycles, 3 full growth cycles, that's essentially gone from $500,000 to $1 million, $1 million to $2 million, $2 million to $4 million. And that's 30 years.
Yep. So the sooner you start, the better.
Yeah, absolutely.
If you can afford the debt.
So that's a real simple way to put it. But if I break this down, and hopefully for the listeners, this is where I want to probably put it into really, really specific numbers, because I think that all sounds like huge, amazing numbers. But the reality is vast majority of people never get there. And for it's a variety of reasons, the ability to buy the right asset at the right time, hold the property, cash flow the property, whatever it looks like. And essentially what I've broken down, and if your listeners want to, I penned an article for my database about a week and a half ago, and I'm happy to share this with the SBI show. And if anyone wants it, I can send it through as well. But essentially it breaks down what happens if you start with that first $500,000 investment. So you've got to get there, and we talked about the sacrifice to get there, because the reality is you've still got to get there. To do that with a 20% deposit, you basically need the best part of $100,000. Depending on if you're 20% deposit, 10% deposit, somewhere in between, bit of lender's mortgage insurance, coupled with some other costs.
Stamp duty and all that
Stamp duty, that kind of stuff. If you're talking $80,000 to $100,000, will get you into that $500,000 price point, bearing in mind that you've got to service the debt.
And that's at like a 90% of what we are.
Yeah, 100%. So let's say we're there. So if we're starting with a $500,000 asset with a $400,000 loan, I'll work through an exact scenario here. So if I apply that 6.3% average annual growth figure that Australian major metropolitan freestanding houses have achieved, and that is the data, then by year 4, factoring that 6.3%, year 4, that property's worth $642,000. So if I'm working off those same numbers, that equates to around about $114,000 in usable equity if you're taking it up to 80% LVR, which is relatively conservative, as you know, Phil, because you've taken your portfolio at certain times higher, then get more conservative over time. But breaking it down to say you're not going to cover LMI, you're not going to go into that territory. So by year 4 on that $500,000 asset, your asset based on the long-term averages is $642,000. You've got $114,000 in usable equity available to you. So here's the thing. You're in a position where if you hold that asset for 30 years, you're almost unequivocally in a position where you will be in a great spot in 30 years' time with that asset. If you choose to take out that $114,000 in usable equity, and granted that you can service an additional investment loan, and we talked about this not going up to 10 assets, we're going to stop this at 2 investment properties only. 2 investment properties only. So you've bought a property, let's say you are 25 years old, 2022 you bought your first investment property, or let's say it was 2021 because the likelihood is you're probably going to get this growth cycle. 2021 you've bought it, come 2025 you're now in the position where that property is now worth $642,000. You extract that $114,000 in equity and you're ready to go shopping to buy your second investment. And we're going to stop at 2 at, again, $500,000 price point. So year 4 you buy, so we're fast forwarding 2025, you buy your second investment. Hold that property and essentially at that time your asset value, total asset value sits at $1.142 million. That takes into account your increased value of your first purchase plus your $500,000 second purchase. Your debt is sitting at around about $900,000, given you bought your first property with $400,000 debt and you fully leveraged that second investment. Now we're only going to go to 3 more time horizons here. Fast forward, so you're doing nothing more. You're basically saying, I've bought my 2 and it's set and forget time. You're doing those things around the edges that we talked about, talking with your broker, talking with your accountant, making sure your cash flow, maintaining your property in between, etc. Come year 10, 6.3% average compounded return. Year 10, what was an asset base of 1.142 value is now $1.66 million in value. So essentially, by year 10, from that first purchase, you're now in a position where your portfolio has an equity position of $766,000. Doing nothing. We're not touching that equity. We're not doing anything. We're maintaining the property. Holding it another 10 years after that. So if we go back to starting points.
So 766, is that sit-down money?
No, that's equity. Yeah. So, and this is the important differentiation because I think a lot of people think, oh, great, that's heaps of money. I can basically take that out and probably replace my income. Well, no, this is not your money to touch at this stage. This is equity.
That's equity. And that's equity the key available. Thing, right? So it means you're still going to have a job.
Still going to have a job. Yeah. And I want to dispel that myth of saying, great, this is now I can take that out and I can disperse it over a 20-year period and I can say I can take that over 10 years, even take a $76,000 annual. No, you can't do that because ultimately this property has it built into it, but essentially it's going to sit there. The property is still going to be relatively cash flow neutral, maybe slightly positive by that time, but nothing that's going to be life-changing. The equity that sits in that property, however, is a big wedge of money. And we'll talk about that in a second. But if we go from, so we've gone from 2021 to 2031 by this time. Now we're going to hold this property, these 2 assets, to 2041. Now by year 20.
Hang on a sec. So this is when things start to change.
Exactly.
And this is when you start getting to that back end of that, a penny a day is when you start getting.
But it's not even, this is only year 3. This is
the second part of the cycle.
Yeah.
We just got another break, Paul. Stay with us and we'll get back into it. This is really interesting stuff. Back in a moment.
Want to slash thousands off your home loan repayments? Whether you're an investor or homeowner, we know how important it is to find the lender that suits your unique situation and with the best rate. If you've not compared your home or investment loan in the last 12 months, you may be able to cut your repayments today with a different lender. That could mean more money in your bank account and less stress when it comes to paying your loan. Find out why more borrowers are turning to Finny to refinance their home loans. Call us now on 1300 002 023 and find out what you could save. Or visit our website finny.com.au to book an appointment.
Welcome back, Phil Tarrant from Smart Property Investment with Paul Glossop. Now, Paul, when you go from year 10, so 2031 to 2041, so 20 years since you made your initial investment, which you supplemented with another $500,000 investment 4 years later. It's when the numbers start really getting interesting.
Absolutely. So again, we're just factoring in what is the long-term growth average of 6.3% for freestanding established houses. by 2041 for this purchase. First purchase was made in 2021, second purchase made in 2025, so 4 years later, and that is it. That asset base, the asset value, is now sitting at $3.123 million. We've factored in that you're not paying off a single penny of this actual debt throughout this whole time. So I'm probably being pretty conservative as to what your actual equity is, because the reality is by this time, you certainly would have switched from an interest only to a P&I scenario. Your portfolio will still be supporting it, so it should be basically cash flow neutral if you're P&I anyway. And that at that stage sits at around about a $2.223 million equity position. Remembering that you started that equity position with that initial deposit of $100,000.
So cash on cash return is pretty big.
2,000% by this time.
And then for those people who've been following the Smart Property Investment portfolio, and we chat about it a fair bit, we talk about the cash on cash return of that portfolio, and the numbers are pretty good. It performed really well. That's only really 10 years old, that portfolio, and already the numbers are pretty good. But to this point here, we actually, at a point in time of refinancing, we actually took the initial money out of it. So it owes us
nothing.
No money.
Yeah, exactly.
Like it's just everything is a free pass on the equity.
Yeah, absolutely. And again, I guess it goes back down to you can take this, depending on your income and your serviceability, that equity, when you talk about it as being left in there, but there are times where people can take this out, extract it, do something with it better, or you can essentially equity release to better the portfolio, better the properties, do whatever you want with that money depending on that situation at the time. But the last step I'll get to, and we can go through this for decades and decades, and you could talk about generational wealth and all the other things that come with that, because that genuinely is where generational wealth in property sits, is it literally passes through 100 years plus, and you can start to think, wow, how do those numbers get that way? Year 30, again, going back to we started with $500,000 investment, $100,000 starting money, whether that came from equity release, a bunch of mum and dad, cash, whatever. 6.3% average annual return. These are real numbers that have happened over the last 30 years, average real numbers. And this can be exponentially higher depending. Your compounded return by that time. So by year 30, that asset base has a value of $5.854 million. So by year 30, we're talking about your debt still sitting at $900,000. And granted, I'm saying you haven't even touched the principle of that. You've essentially just kept it interest only, which the likelihood is that would have basically almost all but disappeared by that time.
So if you went from year 10 to year 30
on a
paying P&I,
you'd have a good 70% of that knocked off, I'd suggest.
Yeah.
So but let's take into account we haven't even touched it, and we're just literally letting this run its course.
Yeah. And so this doesn't actually factor in the fact by year 30, you probably be in a pretty good positive position as well. So it's putting dollars in your back pocket as well.
So you don't need to sell, you don't need to do any of these things, so you can extract equity, etc. But the reality of these two purchases, your total equity position from your first $500,000 purchase, refinance after 4 years, extract the equity, buy second property of $500,000 and maintain the asset base for 30 years, your equity position sits at $4.954 million, the best part of $5 million in available equity, starting with $100,000.
So to put this into context then, okay, that sounds good, right? So I've got a couple of points. Say you started at 30 and you're now at 60. You sell both properties. This, the argument being you need to live somewhere, but anyway, you sell both properties, you pay back $900,000, you walk away with $5 million. But you hear that and just go, no, it's impossible. That's what people will say, it's impossible.
Well, firstly, you don't walk away with $5. You walk away with half of that. The other half is subject to CGT. But the beauty about property in Australia, 25% of that is going to be basically taxed. So call it, you'll get 75% of that. So let's say you're walking away with maybe $3.5 million, $3.8 million in cash after all said and done. That's your payday and that's your retirement. Now, even if you're factoring inflation and cost of living pressures, etc., we've also got right now, you've got the ability to some concessions to chuck some money from sale of proceeds of assets, depending on whether it's your home or not, to put it into your super. There's concessions there as well. So you might be able to actually move some of that money a bit more tax effectively.
Yeah, smart account for that stuff.
But take into account, you're going to pay the full whack of tax. That's a pretty big wedge of cash in that time for doing nothing other than starting with $100,000 and being relatively boring. And it's those two things, mate. It's compounding return and patience.
And patience, yeah. And you speak about generational wealth. And I'm conscious that on the Smart Property Investment Show, we, by and large, most people we talk to and have on the show, and most of the focus is around sort of first-generation investors. We're first-generation investors.
Absolutely, we are.
So we weren't handed a really nice pass, right? We had to start from zero.
But
you think about, your grandfather started doing this, and this is when you sit around and walk around Sydney and you just go, how does everyone afford these really, really, really expensive boats, knowing that salaries aren't that high for most people? That's where it comes from, right?
Yeah, mate, absolutely. And I don't doubt everyone's walked around the harbour or the little waterways at some stage or seen this, holiday beach house and think, how do these people afford this? Well, the reality is the vast majority of them probably earn, decent wage and decent income and nothing that's to slouch at, but they're not earning 10 million a year.
Someone way back when
bought that property and allowed them to access it, and from there they access it, and they were clever with it. A, they didn't sell, and B, they reinvested, and they were patient. Most of the time, if you look under the hood, you're going to see that this is the scenario that plays out time and time again.
Yeah. I don't know whether to be excited or depressed.
Well, mate, I think it's a bit of both, but I think for me personally, it's a life lesson in property because you talk about being excited and depressed. Well, anyone who bought a property 2 years ago was probably pretty excited over the last 2 years. They thought, oh my God, I'm going to make so much money. And now they're going to go through this next couple of years thinking, oh, it's boring again.
Yeah.
It's normal.
Yeah.
But these are the times where you need to reiterate to yourself and other people around you who want to do stuff or maybe sell because there's been some profit on the table saying, great, profit's there, yes, but think about what will happen in 20 years, 30 years, or ultimately if we hand this down to the next generation. Things that can happen are life-changing.
Yeah, it is. And it's a positive influence of compounding growth, right? But you hear the numbers. Well, number one, you go, 30 years, that's so far away. Who cares?
Yep.
So if you want to be an effective investor, you need to be thinking long-term, and that's a key thing. Is short-term wins in property, people that typically blow their dough. They either become mega wealthy or mega poor.
Yeah, absolutely.
If there's such a thing,
Can
right?
I ask you a question, Phil?
Yeah.
And look, you shared this on the Smart Property Investment Portfolio anyway, but to ask that question to yourself is that you say, well, what happens? How has this changed your life? Well, your portfolio, Smart Property Investment Portfolio, which you're part of and started building a decade ago, and you've bought a number of assets across a number of markets, how much has that changed your life?
Zero.
This is the answer.
Mate, honestly, it's a number on a spreadsheet.
This is it. And we talk about the tinkering around the edges. Yeah. You're going through a refinance at the moment. They're the little things that you do every now and then. You pick up the phone from your property manager, you answer an email every now and then. You probably do it less than you should. But they're the things that you do. Beyond that, people ask you about your property portfolio. Yeah, it's there.
Yeah, but that's it, right? But I guess there's potential and kinetic energy. If I get my high school physics right, potential energy is energy that is stored.
Yep.
And kinetic energy is energy in motion, right? So energy is stored. So you talk about the portfolio, it makes zero difference to me. If anything, it's a negative on my life rather than a positive because I've got to think about it, right?
And there's heaps of equity in there.
There's heaps of equity in there, which I don't need.
Yep.
Which is an unfortunate place to be. And I'm just like, now it's a bit of a science experiment, to be honest with you. They're going, which I'm happy to go to people, look at this. This is how it works.
Yeah.
You hear a lot of BS in property. Well, here you go. Here's the portfolio. By the way, it doesn't owe me a cent.
No, absolutely.
Yeah.
And
it's a good thing, but still it gets to the point and you just go, how can two $500,000 properties end up being in 30 years' time worth $5.8 million? You go, that's impossible.
Yeah.
It's impossible.
Absolutely.
But
that's the numbers.
I know. Can you imagine a world in 10 years' time when the median property in Sydney is going to be about $2.5 million?
Do you remember this conversation 20 years ago when you could say, that, could you imagine the average property in Sydney is going to be worth $1 million?
Yeah. Back when properties was like, under $100,000, $100,000.
And you just thought it was farcical. And this is the reality of it. And I think one thing I haven't touched on here, mate, is that if anyone wants to look at some data, CoreLogic have some really good info on a 30-year report, basically breaking down the entire country and 10,000 odd suburbs and their performance over time, regional versus major metro, property types, units versus houses, etc. But I've talked about the average freestanding established house, which takes into account your major metropolitan areas. It doesn't take into account regional areas. But in that same 30 years, there were markets. So that 6.3% works out to be over 30 years, about 454%, somewhere around about that.
So you're bundling up all the bad properties with the good properties.
Exactly. So my point with that, mate, is that there are some markets in that same report. If you bought that same property, they've done 800, 900, 1,000%. So you start to think that doubles that number if you bought that average property and held it over that time. So our job is basically saying, how can we better that average and still get that number?
Is this? I see what's going on here. This is when you say,
this is the sizzle.
This is the sizzle. You go, you can either do it yourself and get a 6.8% one, or go to a buyer's agent.
They'll probably get worse.
We'll try and get you the better ones, right? Yeah. Because you've got to remember, like that's the average, right? There's a whole bunch of properties that perform a lot worse than that.
I'll give you the hot tip. The worst collective market was still about 250% over that 30-year time. the worst collective market, which was regional WA.
In 30 years.
In 30 years.
So 230%.
250%.
Over 30 years. So if you went 1 million times 250%.
Yep.
Yeah, okay.
Which is still not bad. That was the worst you could have done in that time.
If you had a huge debt on it, probably not so good. And
No.
and if your parents are making these stupid decisions, you want them.
Stupid.
They're going to. If they're going to hand down good generational assets, you want them to buy good stuff, right?
Yeah,
You don't want the.
Yeah.
You don't
Don't want the quick money, the Bitcoin.
The Bitcoin money. How many Bitcoin entrepreneurs are parking their money in
Mate,
property?
I've had a few who 2 or 3 years ago were crowing,
Yeah.
and were deciding whether, and I don't want to go into that because that's not my place to discuss something that I'm not an aficionado in. I definitely know property. I don't know cryptocurrency, but I had plenty of people who decided to go down the crypto pathway instead of the property pathway 2 years ago. And I'm not saying that money won't come good potentially eventually, but if you put that into an asset, you leveraged it. Leverage is a word that I use a lot.
Well, it's compounding and leverage, right?
Compounding over leverage. Because if you
can't leverage crypto.
If you bought 500,000 cash and did these numbers, it's a completely different number. And this is where the conversation between the equities market and the property market is always an interesting one, because ultimately over time, the equities market performs a little bit better. It's about 9-ish% versus 6-ish%. But you're leveraging at 80%. So you're getting 4 times the value to start with over that period of time in something that typically pays you a dividend in the equity space, i.e. a yield, which basically allows you to hold the debt as well.
Yeah. And when you start leveraging equities, when you start getting the margin lending, that's a different
Danger.
world. That's when you get a phone call saying, Mr. Glossop.
Yeah.
You
That's
know
how you
that,
lost
mate?
your 2 Ferraris, wasn't it?
That was actually, Lamborghinis. Yeah, Mr. Glossop, you know that $1 million that we lend you? Can we have it back tomorrow?
Yeah, tomorrow. Yeah.
No.
Where's my money?
Where's my money? Yeah, but this is compounding. And if you're going to teach your kids 2 things
Yeah.
around money, if you've got young kids, compounding growth or compounding interest, one and the same largely, and leverage.
Yeah. I wouldn't mind them including patience in that as well.
Well, patience,
especially with the kids.
I think that's the biggest issue you have now with I don't even know what the next generation, they're called Zoomers. I think they've gone and called them Zoomers, right?
Yeah. I think that's what dogs do too. They do the zoomies.
But they what they want to do, like, and I'm generalising, they want the 30 years to happen in about 3 years.
Yeah.
I want it now.
Mate, I heard the same thing. I'm a Gen Y. I heard the same thing when I was going through my 20s, that we want it now. We don't want to work hard enough for it. And you know what? You're going to have a bell curve of all of them.
Mate, Gen Ys are 40 now. Mate. They're old.
I know. I'm 40.
They're old.
I know. I feel bad.
I'm a cusper.
You're cuspy.
I'm a cusp. But all right, that's good. Interesting. So, how do you get your pause on this article that you
Mate,
wrote?
I think people can actually, if they want to give us a call at 1300 98 5428, that's probably one way they can get in touch with us. They can also just email us inquiry that's an ENQUIRY at purepropertyinvestment.com. If they want to ask for the 30-year report, we're also happy to hand that, or I can give them this compounded report as well. And ultimately, they can set up some time to discuss how they can actually get that better than performing 6.3% asset.
Yeah, and there's a lot of people going to be going, this is really general. You haven't taken into consideration interest rate fluctuations.
But this does.
Sort of stuff.
And that's why this report, I can show them over that time, this takes into account recessions, GFC, hyperinflation. It talks about all kinds of booms and bust scenarios. This is what happens over that time.
So it's a real deal.
It's the real deal.
It's the real deal. Well, there you have it. Tip, if you can afford to get in property, probably a good idea. Now.
Time.
Don't wait.
Yep.
Don't wait. Don't wait the fact that it's a rising rate environment and property values are going south. It doesn't really matter.
Completely.
Yep. Unless you're transacting or trading on a 6-month cycle.
Yep, absolutely.
Okay.
And then
so the key things are start early, freestanding established homes perform better than any other asset class in property. Get in there as soon as you can, so don't worry too much about LMI. It might cost you a bit at the front end, but you're probably not going to notice it once the equity starts increasing. And property is a long-term game.
Absolutely.
There you go. The secret sauce from Paul Glossop, Director at Pure Property Investment. We'll get Paul in. For some reason, he's really popular, so I don't know why, but we get him in every now and then. If you've got any questions for him direct, you can send them to the team and I'll ask him. I'll make him a bit more challenging. Editor at smartpropertyinvestment.com.au is where you can do that. Remember, smartpropertyinvestment.com.au or Smart Property HQ on social media is where you'll find us. Quick favour for me, please. Paul, you're not doing enough of this with your clients. Please keep those reviews coming on the iTunes where most of you listen to this. Traffic downloads is through the roof on the Smart Property Investment Show. I keep asking my team to check the numbers to see whether or not they're actually right, but blows me away just how many people are. There's hundreds of thousands of people now
paying for
listeners.
downloads.
Yeah. What do they used to call a like bank? Remember you saw pictures of it, like someone with like 1,000 telephones just downloading the Smart Property Investment Show.
The fact that you know about that is questionable.
I know a lot about a lot of things, but not much about anything in particular. We'll see you again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.
Have you signed up to HR Leader? Go to hrleader.com.au to subscribe. Receive the latest HR and people leadership insights and news.